Welcome to The Explainer. Today, we are diving into a powerful and honestly kind of overlooked decision that can totally change a company's reported profits, even if their sales don't change by a single dollar. It all comes down to inventory accounting, and believe me, it's way more exciting than it sounds. Let's get into it. So let's start with a little puzzle. Imagine you run a t-shirt business. The shirt you bought yesterday cost you $5, but an identical one you bought last month, that was only $4. Now you just sold one. So to figure out your profit, which cost do you use? The $4 one or the $5 one? The answer, well, it's not so simple. And the choice a company makes right here has some massive consequences. You see, for most businesses selling thousands or maybe even millions of identical items, trying to track the exact cost of every single widget is, well, it's basically impossible. And that's why they need a system, a consistent method to account for all these costs. Now, for some businesses, it's pretty straightforward, right? If you sell something unique, like cars or custom-built machinery, you can use a method called specific identification. You know exactly what that particular car cost you because it has a serial number. It's the most accurate way to do it, for sure, but it's just not going to work for a company selling millions of light bulbs or, t-shirts. So what do you do with all those identical items? This is where it gets really interesting. Companies have to make something called a cost flow assumption. Now, this isn't about how the boxes actually moved off the shelf. It's an assumption, a story, really, that they tell for their accounting about which items they sold first. And this is exactly where the strategy comes in. Companies actually get to choose their story, and there are three main methods. You can think of them as three main characters that they can use to tell it. The three big ones are FIFO, which stands for first in, first out, LIFO, or last in, first out, and the average cost method, which, you guessed it, just blends all the costs together. So let's see how these actually play out. To see just how dramatically different these stories can be, we're going to follow a single hypothetical company, let's call it Entity A, and see how its financial results change based purely on which accounting story it decides to tell. First up is FIFO. This method assumes the very first items you bought are the very first items you sold. The perfect way to think about this is milk in a grocery store. The store always pushes the oldest cartons to the front because they want to sell them first. It's logical, and it pretty often matches how stuff actually moves in the real world. Okay, so when our company, Entity A, uses the FIFO method, its cost of goods sold for the year comes out to $2,320. Now, just tuck that number away in your brain for a minute. Next, we've got LIFO, last in, first out. This assumes the newest things you bought are the first ones you sell. A great way to picture this is a giant coal pile. You dump new coal right on top, and the first scoop you take to use comes right off that top layer. It hardly ever matches how goods actually flow, but, and this is key, it's a perfectly legal accounting story to tell. And for Entity A, using LIFO gives them a cost of goods sold of $2,260. Hey, notice that. It's a different number than we got with FIFO, even though absolutely nothing about the company's real-world operations has changed. And finally, we have the average cost method. This is kind of the middle-of-the-road approach. It's like you throw all your inventory, the old stuff and the new stuff, into a big pot, stir it all up, and calculate one average cost. That single average cost then gets applied to every single item you sell, which smooths out all the bumps from changing prices. So, okay, we've got different methods, and they spit out different numbers. Why does any of this matter? Well, because cost of goods sold is a major, major expense. And when you change your expenses, you directly change your profit, the all-important bottom line. All right, now for the big reveal. Let's put all the results side by side. Just look at the differences here for Entity A. The cost of goods sold goes from as low as $2,244 all the way up to $2,320. The company's reality didn't change one bit, but the story it's telling and its final profit sure did. This bar chart makes that difference super obvious. With FIFO, the reported cost is higher. With LIFO, it's lower. Now, it's really important to point out that our example here happened when prices were falling. So what happens when prices are rising, like, during inflation? And this is the crucial takeaway. When prices are going up, LIFO assumes you're selling your newest and therefore most expensive items first. This leads to the highest possible cost of goods sold, which means you report the lowest possible profit. And a lower profit means, yep, a lower tax bill. And right there, that's the strategic trade-off in a nutshell. When there's inflation, LIFO is fantastic for your tax bill. You report less profit, you pay less tax. Simple. But FIFO has its perks too. It makes your inventory on the balance sheet look more valuable because it's priced at more recent higher costs, and it usually reports a higher net income, which investors definitely like to see. So you're probably thinking, can companies just pick whichever story makes them look best at any given moment? Well, yes, but there are rules to the game that keep things from getting too crazy. There's this fundamental reality check rule in accounting. A company can't just keep valuing its inventory at a price that's higher than what it's actually worth today. So if the market value of your inventory plummets, you have to write it down and report that loss. You can't just pretend your stuff is worth more than it really is. And get this. Here's a fascinating little twist. While LIFO is totally allowed in the United States under its accounting rules, it's actually banned almost everywhere else in the world. The International Financial Reporting Standards, or IFRS, do not permit LIFO. Their argument? It just rarely reflects how inventory actually moves. So when you boil it all down, how a company counts its inventory is so much more than just a bookkeeping chore. It is a strategic decision. It's a choice about the financial story it presents to investors, to regulators, and to all of us. Which brings us right back to our t-shirt shop. That choice between the $4 shirt and the $5 shirt, it's not just a $1 difference. It's a choice about the story of your business. So the next time you see a company's earnings report, maybe you'll ask yourself, which story are they telling me and why?